Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. It's been another week of much incident for listed companies. Today on the show, we're going to be looking at the latest calamitous update from oil services company Mony Group, whose shares have slumped 50% in the past week and which has just lost its CFO due to an unfortunate oversight as well. Alex Hamer is here to ask if there's much hope left for current investors or even an opportunity for those looking on from the outside. We're also going to discuss the subject of our big long read this week, Nvidia, a month on from the emergence of China's DeepSeek. We'll take a closer look at how the chip designer's prospects have or haven't changed and how its valuation stacks up in that context. Our tech correspondent Arthur Sants joins us from New York to discuss further. Before that, though, we start with Mony Supermarket, or rather Mony Group as it's now known, spelled without the E for some unfathomable reason. The price comparison business reported full-year figures this week. Mark, you looked at those. The company has been under a bit of pressure because as inflation comes down, there is less incentive for people to switch and to use its services, particularly in the realm of insurance, car insurance, which we'll probably get onto. But how did the figures themselves strike you?
Well, it was fairly solid overall, but there was something of a disparity between different parts of the business. The insurance arm performed reasonably well in the first 2 quarters of this year. Home services lagged by comparison. We saw a 7% increase in the motor insurance unit throughout the year. It slowed down slightly revenue growth during the final quarter. But I mean, that's pretty typical in a way. You rarely get all of the units and some of the smaller ones moving in the same direction.
The insurance is the big part of the business. It's about half of it, or certainly half of revenues, isn't it? That Q4 growth, as you said, it has slowed down, but it didn't seem to be quite as bad as people had feared in terms of the gradient of that growth.
I think there's external factors involved here as well, because if you look at insurance underwriting levels for the motor industry themselves, it's clear that the underwriters got that wrong as we came out of the pandemic, and there's been a bit of a lag ever since then. We've seen an increase, or we're seeing an increase in premium rates across the board now. So whether that impact the group positively or otherwise, we'll have to wait and see. But presumably, if premiums are going up, then there's more incentive to use the service in it.
It's an interesting company in some ways. It has some of the hallmarks of a business you think would be a quality stock. Not all of them. I mean, it doesn't really have a moat so much in terms of the fact there is a lot of competition we'll get on to. And there are some other issues there too. But one thing to consider with money is that total return is how you should really consider them. I think it's fair to say on a share price basis, they haven't really gone anywhere for several years now, but they do offer a good dividend yield. They've returned to a net cash position now as well, and there was a buyback in these figures too. So that side of things is looking a little brighter.
I think that's underpins the investment case to a very large degree, actually. Why this should be so, I don't know. I guess in a way, a lot of that cash is churned back into the business so it can keep up with rivals and drive new business. But, the fact they've had the buyback and they've been able to increase the dividend again to August well, and they're on a pretty decent forward yield too. So that's likely to attract the punters, even though capital growth has been, muted or non-existent, really.
Yeah, they've paid off, I think, some of the money owed for the Quidco deal that they made a few years back now to help them return to that net cash position, albeit a lot of that cash is going on the buyback. Let's talk about some of the nuts and bolts of the business, because one area which they are keen to trumpet is the Super Save Club, which is effectively a kind of loyalty program, it seems to me, which has now passed 1 million users. I think there are some obvious benefits for that, but can we say a little bit about that first?
Yeah, I mean, it's analogous, I guess, to the loyalty schemes that the supermarkets use as well. I mean, there's various advantage for membership. They get kept up to date with different deals across the board there. And I think there's some financial benefits too. I guess as much as anything else, it supports renewal rates going forward. And I think it's got an expanded offering too. The one point that's worth making about Money Supermarket and companies of its ilk is that they have to keep on investing within the business. It's almost keeping a case of keeping up with the Joneses as well, because I went and had a look at the site, which I hadn't looked in years really, and the levels of functionality now are so far in advance to what they used to be. And I think that's where you see this across the board, similar sites as well. In other words, they can't afford to stand still, and the loyalty scheme is just part of it.
Yes, the thing about this is, in theory, it should lower marketing costs, which are a big deal for a company like this because there is a lot of competition out there. It should mean stickier customers, as we say, higher margins as well. Some of the things customers get, I think they get cash back, potentially even some prize draw kind of things as well, extra bonuses on top of that. The question really, I suppose, is to what extent is this something that is needed versus something that could increase growth? Because you're going to increase something we have seen, according to some external measurements and what analysts say, you increase direct traffic with this kind of loyalty scheme, i.e. people come straight to the site because they want to go there and there's a reason to do that. The flip side of that is that web traffic, i.e. people finding you from searches, is under a bit of pressure. There's been competition, I think, from the likes of Go Compare, in particular, Future PLC, who own them, have been putting a lot of marketing spend behind them. There are other companies out there, obviously Money Saving Expert is another well-known one. So it's not a case of it being an auto trader or a right move where they have the market sewn up entirely.
Yeah, I mean, you mentioned the fact they don't have a genuine moat, a competitive advantage in that regard. But I mean, they have to take these measures to keep hold of their existing clientele as well. There's not a great deal they can do about these external pressures, other entrants to the market and existing ones increasing their marketing spend. They've just got to follow suit. There doesn't seem to be any choice for them in this regard. And I suppose if you're a potential investor, that's worth keeping on board. It might also go some way to explaining why it seems to be propensity for returning capital to shareholders.
You were looking at Airbnb the other day, where you see some similarities there in terms of, again, scaling up the operation, or at least adding on a lot of add-ons.
Yeah, with Airbnb, it's interesting because they're looking at adding complementary services. They're going to become a one-stop shop for all travel, all your travel needs, really. Whether that it could extend to travel insurance, I guess, but there's any number of areas. They weren't very specific. But again, they've invested heavily in improving that functionality of the platform. And I guess at least they're in a position where they do have these complementary retail sites that they could add onto it. Whereas, I don't know, with Money Supermarket, is that the full extent of the services that they can offer?
There's also, I think, some suggestion in the market, perhaps, or certainly some thoughts that maybe acquisitions may be a way they look to expand in future again as well. Certainly with this cash position now, they've bedded in some of the previous deals. We should wrap up by talking about the valuation, because we've come through the pandemic period. We're seeing certainly things like insurance inflation, premium inflation normalize. Clearly, those prices are still much higher than they were. So we've come through this area, this time when people are really frantically searching around for better deals. Same on energy. Again, we know prices are very high there, but maybe to an extent, people have found a new supply over the past couple of years and are now sticking with them. That said, the valuation of the company, it's quite a bit below even pre-COVID levels. So it's not normalized to being back where it was before the pandemic. It's quite a bit lower. So do we see an opportunity there?
Well, I think in the past, certainly around the pandemic, valuations for this tech end of the market as well were somewhat febrile. So I don't know if we're going to see a reversion there. They're trading on a sort of a lowish multiple of 11 times. But I looked at the PEG ratio as well, which seems to indicate that the market has adequately priced in their growth prospects going forward. I guess that doesn't take account of the cash returns on offer there, which again, I say would probably be the major catalyst in terms of investment decision. I think in terms of insurance premiums, I think that's going to remain elevated for a while yet, along with energy prices. And one can only imagine that this would provides an incentive to use these type of comparison sites.
It's true, there's probably still people out there who, if they haven't used it yet, they'll be thinking about doing so in the coming months. We're going to turn now, though, to our big feature of the week. It's on Nvidia. Arthur, you've got a lot of information in the piece, a lot of context and really interesting background on the company and how it got to where it is now. But why don't we start from the opposite end almost and look at the current issues, because clearly a few weeks ago we discussed it on the show at the time. It would be good to get your thoughts with the benefit of a few weeks worth of the dust settling on the DeepSeek issue, this lower cost Chinese AI model, which worried investors, albeit very briefly, investors in AI companies, the hyperscalers, the big tech giants, and Nvidia, insofar as the thinking was perhaps all this spending that they're making, all custom they are putting with Nvidia, won't be needed to the extent that we thought in the past. We're now at a situation where Nvidia has recovered a lot of those losses. The tech companies are reaffirming CapEx spend. They're saying, no, we're going to expand that expenditure again this year really quite significantly. Institutional investors have seemingly been buying the Nvidia dip as well. Do we agree with the fact that it's perhaps business as usual, or people seem to be trying to make that case? What are your thoughts?
Initially, the fear was that because the DeepSeek model was supposedly more efficient and cost less to train, that the CapEx spending would come down. But then in the last week, the big tech companies have all reported and they're expecting CapEx to go up a lot. And the comments from the CEOs, so Satya Nadella and Mark Zuckerberg and Sundar Pichai at Google, was that this DeepSeek model wasn't going to change their thinking that much, and they were going to crack on with their massive amounts of CapEx spending, and they still see the risk more to underspending than overspending, and their concern is falling behind in the race more so than it is overspending on CapEx and then being left with a few too many GPUs than they need. And I think part of the reason for this is, as a few of them have come out to explain, it's this idea of like more reasoning. So it's basically, rather originally the models were just getting bigger and bigger and bigger, which meant more data and more parameters. But now, as they're sort of running low or on data and they're seeing less returns to that structure, they're doing more reasoning, which is when you have two models or three models or however many models you want, but one model, which might be a bit smaller, will look at a task, and then if it can complete the task, it would complete the task. But if it was struggling, it would then pass it on to a different sort of model. So it's sort of models stacked on other models. And this means more thinking time for the machine. So you might put a question to it and it might take a while. Like OpenAI's deep research, which is its most expensive model, it's like $200 a month, would spend a while coming up with a response. So the theory there was actually that would need even more of NVIDIA's GPUs, because the models would be like quote unquote thinking for longer and would need more of their chips, which is possibly why they're increasing spending. And the market seems to reflect that. I think NVIDIA is basically back up to where it was before the DeepSeek announcement.
It does remind me a bit of Meta's seamless pivot from the metaverse to AI by saying, no, we've got all this spending and it's going towards AI. This shift to reasoning, saying the big jump in AI demand is going to be because we need it for complex tasks like reasoning, as you've just explained, which may well be the case, but the argument has changed slightly, and for now everyone's still on board with it. But let's talk about some of the other threats to NVIDIA, or potential threats to its clearly a position which has got it to the top of the market cap scale globally. Competitively, there are two companies in the US, AMD and Broadcom, who are trying or have been trying to muscle in a little bit on its turf. How well have they been doing that? What are the sort of latest signs there?
In the case of Broadcom, they aren't direct competitors. So Broadcom has these chips called A6 chips, which they've signed contracts with basically all of the major hyperscalers. So Microsoft and Google, and including they just reportedly signed a big deal with OpenAI as well to help them design their own chips. But the slight difference with A6 chips is they're really, really good at specific tasks. So in the case of AI, they're designing these chips alongside Broadcom that are really good at training the models, which is useful and could displace, and probably would displace, some of the demand going to NVIDIA, because those GPUs are currently being used to train the models. The slight difference between the two, the difference between the two companies is the A6 chips are for very specific tasks, whereas the GPUs are actually general purpose. They can be repurposed for a load of different stuff. So obviously originally the GPUs were used for gaming graphics, which is why they're called graphics processing units. And then for a while they were in hot demand because they were being used to mine loads of crypto. And then now they've been repurposed to do all of this AI training, which has been a big growth driver. But that's been the strength of Nvidia, is actually the fact that the chips can be, Nvidia often doesn't really come up with the uses for the chips. It's the fact that the chips are all out there and other people are coming up with the uses for them. And actually back to the reasoning point, for now, like the A6 chips that had all been designed for training wouldn't actually be able to be repurposed for inference and reasoning. Whereas the GPUs, if you bought them for one purpose, you can switch them over to another purpose. You might have been using them for training, and then you finish training your models, which is a one-off action, and then you want to then use the chips for reasoning and inference. You can just reprogram the chip rather than having to buy a whole new specific chip. So that's like a particular strength over Broadcom. But Broadcom sales are going up a lot, and they've signed these big contracts, and it makes sense that the hyperscalers would want an alternative supplier. So that would chip into Nvidia's share a bit. And then in the case of AMD, there was quite a lot of hype around them last year, and they released this GPU and said it performed on par with or better than Nvidia's equivalent GPU on loads of metrics. But recently, the sales have not been that impressive. And I think last year was like they said I think it was 5 billion for the full year, which is only like 4% of Nvidia's sales. So they're not taking a huge chunk out of the market. And the reason for that is they're difficult to reprogram because Nvidia has this language CUDA that it created that makes the chips easily reprogrammable, and all of the AI scientists use that as their main language, but that's proprietary to Nvidia. So it's a pretty big moat around Nvidia's business, and I think it's made it hard for AMD to take a chunk out of the market. But again, I guess it's nibbling around the sides, and when a company has a big valuation, any sort of threat to its growth can be concerning. And if that changed going forward, if AMD managed to pick up traction, then it would definitely be something to keep an eye on.
There are other potential headwinds, which maybe we'll skip over just for now. We do talk about them in the piece. The China sanctions, which are clearly already in place, and there's a potential. You look at the amount of business going through Singapore from Nvidia, does suggest there's maybe something being rerouted then, but that's perhaps a story for another day. Let's look at the valuation itself. In the context of a company that has seen its share price go up by so much over the past couple of years, and in the context of its current dominance, the valuation isn't that bad in and of itself. Is that fair to say? Albeit perhaps you need to believe in a lot of the narratives. Well, clearly you need to believe in a lot of the AI narrative to support it at these levels. What do you think?
But just to touch on the China bit quickly, maybe in the few days since I wrote the piece, that I think the China story is the bigger bearish part of the Nvidia story, because China and Singapore, and there's America's investigating whether they're shipping GPUs through Singapore to China, make up over 30% of its revenue. And actually, I think the DeepSeek story, the actual bearish part of the DeepSeek story, is the fact that it came out of China. Not that it's an efficient model. I think if it had come out of the US, people wouldn't have been as worried, but it just adds to the level of concern that there is development going on in China, alongside the Huawei chip that they made for their phone last year under sanctions, that they may be more innovative than the US thinks, and maybe also could be potentially producing a chip to rival Nvidia's. It just adds to a level of uncertainty about how much competition the US is going to face from China, on top of the sanctions that will stick around for a while. So I think that is actually probably the biggest concern for future growth. But onto your valuation question, yeah, when I was looking at the valuation, which I guess I kind of knew, but just really looking at the numbers again, it's sort of surprisingly low. Nvidia's forward P ratio is 30, which is around the same as Meta and Microsoft, even though that its growth rate and its margins are much more impressive. And then when you take into account the growth rate, there's this PEG ratio, which divides the price to earnings ratio by its growth rate. And Nvidia's is 0.7, which is way below the wider S&P 500. So on lots of the sort of traditional metrics you would use, and its cash flow yields 1.7%, which isn't amazing, but it's not awful for a company that's been doubling its revenue for the last couple of years. So on loads of those metrics, the valuation does look super reasonable. And I think I sort of come to the conclusion that out of the big tech companies, they're all incredibly reliant on AI, the AI story, and their valuations are all reliant on the AI story. The difference with Nvidia, though, is it's got a monopoly of its market. Whereas Alphabet, Google, Amazon, Microsoft, they're all competing with each other. They're all spending billions of dollars to make these models, and these models are all seemingly on a similar level to each other and appearing to become quite commodified. So they're going to have to find ways to compete with each other. Whereas Nvidia, for now, doesn't really have that much competition. So if they do find a way to make these AI models profitable and to have huge commercial prospects, for now, you can't really look beyond a lot of that value still accumulating with Nvidia. So I slightly end the piece on a optimistic tone about the valuation, and it's come down a lot since last summer as well. It's like was peak expensiveness was around June and July last summer, so actually it's looking more affordable than it was then.
Ultimately, as you say as well, it does come down to the AI story and whether that does translate into commercial applications, i.e. other companies using it and finding it to be something worth paying for, something that boosts productivity. I mean, to me, there still seems to be, from the consumer's point of view, AI has kind of been foisted upon them by a lot of the big tech companies, i.e. using Google and adding it to Microsoft and Google's own products as well as search. But the interesting thing, as you've been writing as well, will be to see whether it translates into actual productivity gains at companies. Some people seem to still think it will be doing all the functions for people, which who knows, maybe it will. But right now it still seems, from the way I at least interact with it or have interacted with it in the past, it's more of a summarizer, a good prompter, things like deep research you mentioned, which is the ChatGPT, the most expensive service they have there. They talk about all this research. There's still huge issues with a lot of the output it creates, but at the same time, it could be very useful as something to use as a launching point. So I don't know whether we're at a stage yet where we can really see these huge productivity gains, but we can certainly see some time-saving gains being made. And of course, the companies say, well, it's going to get much better. And if we get to an AGI level, then well, that's going to change everything. But soon, you would imagine we might have to get to a situation where we need to see some tangible results in terms of how companies are using it, rather than just saying we're using AI and whatnot. Is that fair?
Yeah, I think that's fair. Well, I use it to, yeah, as you say, get a head start on stuff. So if I'm interviewing a CEO of a company I haven't covered that much, I'll just have a conversation with the ChatGPT about what the company does and just try and get a head start so I can go into that conversation better informed. But I would never trust it to give me factual, correct output, which seems like a big issue. Like you wouldn't set deep research off in place of an employee because you can't guarantee that what it's producing is actually correct. Everything that needs to be fact checked. I think that might be part of the reasoning switch as well, is they're just trying to find ways to sort of get the AI to double check itself so that it produces more accurate output. Until they can fix that issue, it's hard to imagine it replacing swathes of people in the workforce and generating these trillions of value that people are forecasting. The last point that Nvidia, the most recent market that Nvidia is also hoping to tap into, is the autonomous vehicle market, and it just released a new platform called Cosmos, which enables companies to render cars in a virtual environment and then test them. And Jensen Huang, who is the CEO of Nvidia, was making quite bold claims about the massive size of that market. But again, autonomous vehicles have always been promised to us a year in the future or another year in the future. So until that future arrives, there's always going to be question marks about valuations and growth rates and the amount of capex these companies are pouring in.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. It's time to move on to our final segment with Wood Group, the oil services company. As I said at the top, it's been another disastrous week for the firm, Alex, and that's because the cash flow, the positive cash flow they've been telling us, again, for a long time, that will be around the corner, has been pushed further back. That is, well, a headline of several headlines with Wood Group this week, but what can you tell us about?
Wood Group, the oil and gas, energy, engineering and consultancy, long-storied company operating in the North Sea for a long time, Middle East, now all over the world, has announced that significant free cash flow that they had guided for 2025 will not arrive. And the reasons why are a bit of a window into what's going on with the company. And the background here is the shares have been reeling basically since mid last year, when a bidder pulled out of a purchase of the company, a buyout. And that was the second time that had happened in 2 years. So the company was already looking at a weak point after two buyers had looked under the bonnet and walked away. Apollo said the price was probably a bit much for what they saw, and then Sadara blamed it on macroeconomic conditions. And then what happened in November was Wood Group itself announced that they were having to do an accounting review based on how they'd treated contracts largely in the projects business, and that knocked the shares further. So shares are already way down. Basically, what investors were looking for at that point was evidence of a really strong underlying business, and to get that evidence, the management had pointed to significant free cash flow arriving in 2025. What they now say, we're obviously quite early into the year, but this year they expect a significant cash outflow of $150 to $200 million. And the free cash flow, the long promised free cash flow, will arrive in 2026. This knocked the shares off by about a third last week, and investors have just kept selling since then. So it's looking pretty dire. The market cap is well under £200 million now. This was a £5 billion company a few years ago. Yeah, it's a pinch point for Wood Group right now.
The other part of the backdrop to this is that they've been moving away from the kind of lump sum projects that have been a particular bugbear for the sector or the subsector as a whole. Clearly, that's been overshadowed by these changes too. They are still in the middle, as they would say, of this transformation process. Maybe, though, we can just skip on to the debt and refinancing situation, because that is perhaps a more immediate issue or something that investors will be looking at very closely right now in light of the fact that they're not producing positive free cash flow.
I think just quickly, the shift away from lump sum turnkey work, we've heard it over a series of years from Ken Gilmartin, the CEO. They are now pointing to that as one reason why EBITDA for 2024 has come down and will remain down this year, because their project work has declined, because people wanting an oil rig installed or a wind farm built, they're used to signing projects on this basis where they say, we'll pay you this much to do the project, and then you get it done with that price in mind. That works for us. Wood Group doesn't want to do these projects anymore. They do a cost plus model where the risk is either shared or sits with the client. It's all tied into this current crisis. What they're also facing, as you say, is most of their debt coming due next year, so October 2026. And mostly companies will want to refinance that kind of debt before it hits current status, so before it gets within 12 months of maturity. And so that work is kind of well underway. The risk is that lenders they see the spine of the business and don't trust it. Why would they extend those loans? And it's this precarious position. And I think the question that is really there is, what is the capital markets future of Wood Group with these two situations where management is insisting that the underlying business is still good, there's rising demand for oil and gas projects, they've got an order backlog, or they've got a pipeline of over $6 billion. That remains positive. But then you've got the other side where they have to both maintain the interest on this debt, which has gone up. I think the H1 24, that was about $60 million just on the debt maintenance. And then they also have to work out a new option. They were asked last week whether they would issue new shares, I think at 25p a share, when they had a buyout offer for 230p a share last year. I think that's going to sting. But I think the example in this exact industry is Petrofac, where they had a much more of an issue with these lump sum turnkey contracts, where you actually have to put up huge project guarantees in case you go bust. So they got stuck in this loop where they didn't have the cash to put up, so they couldn't get new work, and that kind of put them on this really vicious circle. But Petrofac shows that there's a huge business here that is really important to global energy networks, and that will maintain. Whether it remains a publicly listed entity is the question. And Petrofac has had to hand most of the company over to the debt holders in order to survive. Its market cap is just above £100 million now. The question then is, what happens with Wood next? And it is possible that the company comes out of this having refinanced, having moved into free cash flow. But because of this accounting review, the CFO has resigned this week because he lightly overstated his accounting qualification and certification, which is another stick in the spokes. The question is whether they can manage all of that and get back into a sustainable, I guess, run of business. And we will find out. I think there's just so many little technical details that has led them to this that it looks like a combination of either serious bad luck or complete overstatement in previous periods, not in an accounting sense, but in a forecasting sense. I mean, they were looking at bringing across tens of millions of pounds from the pension surplus in order to get to this free cash inflow for the year. So there's things like that that have been reversed or not happen and have led to this situation when they all came at once.
I was going to mention the CFO, but you touched on it, and there's not much more to say, really. It is a relatively minor overstatement. I think you said it means, because it's an Australian qualification, he would have taken 13 exams rather than 15.
Well, that was the British difference between the certified
Right.
practicing versus chartered, but it's possible the translation of those didn't come through
Yeah.
properly. And I was just having a look, and this was actually our colleagues downstairs asked Wood yesterday to justify his statement, or him calling himself a chartered accountant, and he wasn't listed on any of the registers. And it's in direct reaction to that he's resigned.
Indeed. Well, as you say, everything coming at once, and that debt issue is the big thing to keep an eye on in the weeks ahead. There has been some small positive news today. They've announced an extension of a contract with Shell, which has sparked a minor, and the circumstances relief rally, still down very much over the past week, but lots of issues there, clearly. Thank you very much for that. We have run out of time, unfortunately. We've come to the end of the show. Thank you to Alex, to Arthur, to Mark, and to our production team. We'll see you next week on another Companies and Markets show.